Good evening, everybody. How are you guys doing? I hope you guys are having a great evening. And thank you so much for your time in joining me in our webinar number 40. So we have been doing this webinar for around 2 years already. And I hope you have been enjoying this series. And every week I try to think of a valuable topic to share with you guys. As you can see from my backdrop, I'm traveling actually this week, but that's not going to stop me from sharing a little bit more with you guys on some of the key findings that I found over the past 2 weeks. And today we're going to spend a little bit more time talking about one particular market and some of the key ways that I feel is most direct and the simplest form for you to gain access and exposure into this market, and which is the Chinese market. So without further ado, let me share up the screen and we can jump straight into the topic. All right. I hope you guys can see the screen. Do pop up on your chat to let me know if you have any question along the way, or you have any uh, things that you want to discuss with me along the whole presentation. Today, we're going to spend a little bit more time into understanding how's the Chinese market doing, and whether this could be one of the key opportunity for us to look into over the next few years. Is China about to make a big comeback? Of course, as usual, just a quick disclaimer, all the work that you see today and all this presentation is actually created by myself, and I'm currently a wealth advisor with iFast Global Market in Malaysia. But please take note that whatever I'm published here are not investment advice or recommendation, and it does not in any way represents the view of my company. These are just based on my own personal research. So do take this webinar as for educational purposes only, and do your own research when you are planning on your next investment. And I hope you guys have been following some of my webinar for quite some time, and this is part of a series that I hope that I can continue to do and even do a little bit more frequently in the future, where every 2 weeks I'll be hosting an hour-long webinar, and I will find the most interesting topic that I feel will be valuable for you guys. So sometimes I talk about individual stocks analysis and how I analyze a company from start to beginning, how I even screen them. A big part of my work now involve ETF, which is exchange traded funds. I wanted to highlight to all of you why using ETF could be, in my opinion, one of the simplest and best and most cost efficient way for you to start building up a very diversified portfolio and a very systematic way for you to build wealth for the long term. Right. So all this will be incumbents inside my webinar topic, and today we'll just touch on one part of it. If you are new to me, just maybe a quick introduction. I myself has been sharing investment content and education content online for many years now, and about 6 or 7 years ago, I have also co-written a book with my friend called Value Investing in Asia, and this book has actually opened the doors for us to truly understand how to apply value investing concept here as an investor here based in Asia, and how we should really think about investment in the long term. As I mentioned just now, I am right now a wealth advisor with iFast Global Market. And iFast, if you have not heard of us, iFast is actually a listed company in Singapore. And we basically, you can see us as a wealth management platform where we allows you to gain access to any type of asset classes that you might want to invest through our platform, be it stocks, ETF, unit trust, managing your retirement funds, as well, linking to your EPF and bonds and also funds that is within our company. All those would be a one-stop solution within our platform. And a lot of the things that I do revolve around my philosophy that I have kind of created for over the past 16, 17 years where I have been investing. And I have tried many different style and strategy of investing, but what has really worked for me is focusing, I think, on these four key ideas, which is really looking at very long-term macro opportunities, like spotting things that could potentially uh, take us have a good tailwind for the next 3, 5, 10 years, maybe. And a big part of what I do, instead of focusing on where we can find the best opportunity, right? Where can we search for the best return? I flip it around and thinking and see it as how can I minimize my risk to the maximum when I'm investing in the stock market. Because my idea is if I focus on high quality companies and high quality funds, uh, it will appreciate over time. Right? Just like fine wine, it will appreciate over time. And my key role as an investor is really how do I mitigate that risk to ensure that I don't do anything stupid and fall into an investment pit. So that means that I try not to chase the market, I try not to time the market, but rather learning to stay calm and think a little bit contrarian to what the general market could be thinking. And that in turn helped me to have a strategy to create what I call an everlasting portfolio. So something that we can start small, but even as we scale up, the same strategy can be repeated over and over and over and over again, which it's very, very key because what we want is to ensure that when we're investing in the stock market, we want to make sure the power of compounding stays within our advantage, meaning that we don't disrupt it unnecessarily. And the longer we stay patient with our portfolio in building an everlasting portfolio, we can see that the scale of compounding will improve over time. And this has definitely worked for me on a personal level. And I have started investing, about 17 years ago. And what I see is, although it's not a smooth ride, is never really a smooth ride at any one point of time. But the longer I stay invested and stay faithful to my strategy, uh, the level of compounding that I see is starting to snowball, and I see it more and more significantly within my own portfolio. So this is kind of the key idea that I wanted to share with all of you guys, which is that uh, things might move very, very slowly in the beginning, and it will test your resolve in whether that this kind of fundamental investing could really work. But what you'll find is the longer you stay invested, the longer that you practice being able to build your wealth slowly in the stock market, the more that you'll see the impact over time. So, if this is something that you want to speak to with me one on one, right, having a discussion to understand your current situation, how we can come out with a solution that is personalized for you to have a program to build your wealth through our iFast platform, you can definitely reach out to me either through this Google waitlist sheet, or you can reach out to me from my website learnwithstanley.com. But I encourage you to click and fill up the form because from this presentation, if you are one of the few people that would like to speak with me one on one, I also share with you a little bit on some of the bonus content for this webinar, which is I have created just an infographic on some of the things that we will be talking about, and also some actionable steps on how you can gain access to the China market. Just a quick infographics for you guys. If you're interested, do reach out. to me, and we can speak a little bit more. But let's go straight into the key topic for today, which is navigating the dragon, right? What is the strategic uh, solution and strategic positioning that we should look at for Chinese equity from 2015 and beyond? Firstly, let's discuss about what is the problem that is facing right now, right? If you have read the news or if you have friends in China, you realize that the problem is the current situation isn't as rosy as it used to be maybe like 10 years ago. But we will also analyze a little bit on what does that mean? What could be some of the risks that they are facing? What are some of the things that they are doing to improve the situation? And then uh, when we talk about investing, everything has a risk, but everything has a price as well, right? Is the Chinese market reaching a point where uh, the valuation is very attractive and is worthwhile for us to take this risk? And how at the end, let's take a step back on how we can plan that around our entire portfolio, and which is something that I tend to do for my clients, which is not focusing on finding one particular funds or one particular opportunity for them, but rather, yes, even after we identify the opportunity, we take a step back and how does it apply to your entire portfolio, and how we should be sizing it and positioning it to help you have you can maximize your opportunity without taking on too much risk. Okay. So stage one, should we be investing in China right now? What exactly is the China market and what are we talking about? To maybe go back to the very basic first, I wanted to highlight to you when we talk about the Chinese market, what are we really talking about? What can investor like ourselves be able to invest in China, right? And when I talk about shares that we can invest that is linked to China, these are some of the key categories that we can think about, right? Of course, the China mainland market, they have two exchanges, one in Shanghai, one in Shenzhen, and within that, they would separate it into A shares and B shares. So typically, A shares are the shares that the domestic market investors will be buying and selling. And then they have a smaller group, which is called the B shares, which are historically only access to foreign investors. But now, of course, even the Chinese investors are able to invest in them as well. And then we have those that is listed in Hong Kong, and those is what we call the H shares. So the most famous of them all, of course, is company like Tencent, Alibaba. Those are the head shares that's listed on Hong Kong Stock Exchange. But in the Hong Kong Stock Exchange, this is maybe a subset of them where people might call it red chip, which are stocks listed in Hong Kong, but is actually a state-owned enterprise of the Chinese government. So most famous of them, of course, all the banks would be under this category. And over the past 10, 20 years, some of the best performing ones are what are often listed in the US stock exchange. So this would be the Chinese ADR, right? And we will buy and sell them through the US market. So many companies are also listed there. A Chinese company are listed in the US exchange. But you will see more and more because of the current trade war, more and more are looking at maybe having a dual listing. So Alibaba previously was only listed in the US market, but a few years ago, they have decided that they do a dual listing and they are now listed in the Hong Kong Stock Exchange as well. So my expectation is over the longer term, if this trade tension continues, more and more Chinese companies sooner or later they would want to have a listing here in Hong Kong or maybe in the future in the mainland exchanges as well. So When we talk about the Chinese market, what are some of the indices that we can follow, right, to understand how the Chinese market, how is it doing as a whole? Some of the key ones is this CSI 300 index. So this would combine most of the large companies within the Chinese stock market. And you can see that the breakdown of the index would involve a lot of financials, IT. When they say IT, I think that a key thing for us to understand is IT doesn't necessarily means like tech companies and software companies. A big part of China infotech industry is actually in the manufacturing of semiconductor. So actually, a big part of the weightage is within this space and for these companies. So these are one of the key ones that we can look at. One of the maybe something that we don't really talk about is this Golden Dragon China Index. So this only tracks all the Chinese company that is listed in the US market. So you can see that they actually don't have a very big group. So a big part of it are all the mega caps within that is listed in China. So your Alibaba, your JD.com. So this will be within this index in particular, only highlighting those Chinese company listed on the US. And of course, I think the main ones that we tend to focus on is the Hang Seng Index. Right, Hang Seng Index predominantly previously, of course, focused on Hong Kong companies, but I would say over the past 10 years, it has been completely overshadowed by most of the mainland companies within the index. So the big part of the banks as a big weightage within Hang Seng Index. Companies like Tencent, Alibaba, they're all under Hang Seng Index right now. So I would say if you are, just starting, try to understand the Chinese market a little bit, want to track the market a little bit, these are some of the indexes that you can follow, uh, through Google or on the news, just to get you a sense if you're new to this market. A key thing for me is when I talk about investing, I would really encourage you to first get familiar with the market first, like understanding as much as you can about what interests you in the market, and find out more. Because if we are long term investors, a big part of it is that we have to be comfortable in what we invest. So, say for example, if you are planning to invest in the China market, the last thing that I hope for you is actually that, if you once you invested, maybe something happened, the market has a sudden drop and it spooked you, and you end up maybe selling at the worst possible time, just before it recovers or anything, because you're uncomfortable with the market yet. But on the flip side, if you spend a little bit more time understanding it, you get comfortable with it. So by the time you buy into it, maybe the stock market might fluctuate, but because you are already familiar with what you're investing, you feel a little bit more calm, even as the market fluctuate, and there's a higher chance for you to stick through it and really invest for the long term. And like I said, previously in the first 10 minutes, that the idea is to find things that we can really invest for the long term and let compounding do the work for us. So that's the three key indices I want to highlight to you that you can first look into. But I also want to talk to you about what are some of the key things that is facing, that is giving the Chinese market a little bit of a trouble at the moment. Of course, the main thing that I guess everyone already knows about is the property market. And it is going through what we call the great deleveraging. We know that property market is uh, has always been a key part for the Chinese market and a big sector to contribute to their GDP. And unfortunately, property is also fueled by uh, leverage. So as the property market booms, the banks are more likely to lend, developers are more likely to be more aggressive, and people are more likely to be comfortable to take loans to buy new properties. So when the flip side happened, which is what is happening now in China, where the property market is not doing so well, everything needs to reverse, and so they are at a point where they need to slowly resolve the debt issue of the property market, and that really started. What prompted this deleveraging is that the Chinese government decided a few years ago that the property market is becoming too speculative, and they issue that all property companies, developers need to adhere to three red lines criteria, which is more or less which are things that want to control their debt level, meaning that they cannot have too high of a gearing, they cannot take too much loan to fuel the property market even more, right? And only for companies that is able to meet all the criterias, the three lines criterias, then the next year they are allowed to increase their debt. So if they can't, uh, if the red color, if they breach all three, they are not able to meet all these criteria. They cannot increase his debt. They have to pay down their debt slowly. But in the debt fuel environment, you could see how this can act as a huge handbrake to the economy in the property market and created huge panic across. And it has led to some of the biggest downfall of Chinese developers, right? The most famous one, of course, is Evergrande, which collapsed a few years ago, and it's now in liquidation. It was at one point one of the largest property developer in the whole of China. The other big players also is facing some problems. Companies that we might be more familiar with, Country Garden Holdings, is also one of them. One of these companies that are facing a big issue with their debt restructuring as well. So what's really happening is that the whole market needs to consolidate, needs to clean house. So, but the government is understand that the property sector is still a huge part of the economy, uh, and they're taking a cautious approach on how to make this domino fall slowly, right? So their approach is actually focusing on these three key things, which is they want to ensure that whatever project has already started, the government will be a backstop to make sure that all these project will continue. They don't want any big abandoned project. So if the developer has already sold this unit, it's under construction, even if the developer goes into bankruptcy or face financial issue, the government will step in as a backstop to provide the funds to make sure that the project will complete and the purchaser will get the property. Next is they want to manage the fallout. So they would they have a few case where they will take over the project and then maybe change it into low cost housing or a more affordable housing for the masses. Their thinking is that property should be for staying rather than for speculation, which has been a big case in China for many years now, that people might buy more and more property as a store of wealth, as speculation, or even as investment. So they're trying to not say clamp down, but reduce this kind of unnecessary demand. So, what could be the longer term outcome for such a situation in China? Well, of course, we don't have a crystal ball. We won't really know how it will pan out. It's not looking good right now. I was just talking to a colleague of some of my Chinese colleague, and they have commented that even them or their relative have property that is currently under the value of their mortgage. So meaning that even if they sell their property today, they will still end up with some debt at hand that they have to pay back, right? So it is quite drastic, right? These are things that we hardly hear about in our market, but this has been the reality in many of the cities in China. And what's maybe need to happen is more and more consolidation, and we could see that maybe sooner or later, uh, the government will take up a bigger and bigger role in the development space, right? The state-owned enterprise companies could take a bigger and bigger role in this sector to ensure that the market could grow in a more sustainable manner in the future. And there will be a shift more towards real demand, serving real demand, and really serving sellers, buyers who are buying to sell rather than building an investment asset for investors. So, as China reset this expectation, right, it could take a while because this has been the practice in China for over the past 20 years. And they have seen a property boom since China opened up. So this could be a big reset for them. But if they could resolve that, it could lead to a much healthier market in the long term. Okay, so the second pain for them right now has to be the never-ending trade war, right? And this is the item that have me still adjusting the slide up to yesterday midnight as the news start rolling in from the US. Because in on the 12th, which is yesterday, 12th August, was supposed to be the deadline between their negotiation for the tariff, but it seems that that's not happening, right? And what has happened is since June and July, over the past few months, there has been periods of very high tension. But the US and China actually reached a 90-day truce, right, to work out a trade deal. And the key idea was that US could start allowing export of technology again, mainly things like Nvidia chip, AI chip back to China, while China agrees to ease the restriction on export on some of the critical rare earth minerals that they have a monopoly on. Things go in and out. You know, sometimes President Donald Trump will say something crazy, and the situation become tense again. And just when the expiry was reaching yesterday, in the last few weeks, then we saw President Trump announcing more hawkish announcement, right? Having a steep 100% tariff on technology related stuff and things like that. And then yesterday, they announced that they would have an extension, another 90-day extension on this expiry. So it'll go up to 12th of November right now for the discussion. So all this uncertainty only leads to more and more lack of investment in China, everyone is sitting at the sidelines, seeing what will happen, and seeing a slowdown in the economy. The GDP itself for China has actually slowed down over the past few years already since 2000 and since COVID time. After COVID uh, stabilized, it has you can see that it has stayed in that level for 3 years. This year they are expecting to see some growth, right? They are expected to hit their target of growth of about 5%. But a key thing that I wanted to highlight to you guys is that how they might be reaching that target. For one, at least in Malaysia, and I'm sure in Singapore or all over Southeast Asia, we are starting to see more and more China imports on products into our market. And the pricing is extremely competitive until the point that it becomes very, very hard for our local producer to compete, right? And you have to start to think that how is it possible for them to really make money at such a price point where our local producer will look at it and it is something that is almost impossible to compete with. So there could be a few explanation. One is they can really do it for such a cheap price and still make decent profit. Or two, they are producing it but not really making any profit of all this product, right? Or very, very minimum. And if that's the case, maybe they're just doing it to keep the lights on, to make sure the people are employed, to make sure that the economy would still continue to move. But the problem is because all these prices are going lower and lower and lower as everyone snatch for a job just to maintain their capacity, it leads to something more dangerous than an economy recession. It could lead to deflation, which is something that I think China would really, really want to avoid at all costs, right? So, what could be the path forward? We talk a little bit about deflation, and if you look at what's happening in China and how the US is tackling the rise of China, we see very, very similar traits in the 80s and 90s, where US is threatened by the rise of Japan. And a lot of the strategy that the US is doing now to China has also been used when they try to contain Japan. And Japan, really after their bubble pop in the 90s, they see a long decade of deflationary environment. And that is something that I think China really, really want to avoid. It might seem right now on paper, or at least looking at the situation, that China could really potentially fall into this situation. That certainly is a possibility that China could face such a situation. Especially now we see their property market also popping again, very similar to Japan. Could that leads to that deleveraging that we talk about? Could it take 10 years, 20 years maybe, given the size of China compared to Japan? That their whole economy could just stay stagnant for such the whole generation. Possible. But another possibility is that why this might not happen in China, because China is not really Japan, right? At the end of the day, China has a one-party system, and that has some advantages and disadvantages. But one of the key advantages is that they have policy autonomy, meaning that the state can dictate a lot of things without challenge. And if they already know that the current situation that they're facing could lead to a big deflationary environment for many, many, many years. I'm sure the policymakers has think about it and has put up plans on how to tackle this problem head on. And if you've seen how the Chinese government tackles situation, you know that they are not timid in their implementation, right? And they will go all out if they need to. So that's give me a little bit more confident, that China might not really face what Japan faced, and they could come out of it in a much better shape compared to Japan. Why am I talking about all these things, right? I wanted to share a little bit behind some of the fundamental things that's happening before we talk about the stock market, before we talk about what we can invest in, what are the things that you can look at as an investor. Because at the end of the day, investing is about finding places where the expectation has a mismatch with the valuation, meaning that we can find a bargain in the stock market, right? If something that is extremely great and everybody love it, say for example, now with the AI boom, everybody love it and everybody expect it to go to the moon. This also means that many of the companies that are related to this industry has sky high valuation. And it begs the question whether the expectation has already been priced in to the stocks. And if you buy it today at 1,000 times PE, or most of them doesn't have earnings at all, does that mean that you are already paying for the future? Then maybe when the future comes, if it really is as great, then you might not see a huge jump in the stock that you already own. Or if the expectation falls short of what is painted right now, then there's a higher chance that you will end up losing money in your investment as well. So on the flip side, for China, things are looking very, very bad. But I would say that there are some spots, some bright spots. And certainly, at least this year, China market has been the best performing market globally, I think. And that also means that the market is also starting to feel that things might not be as bad as what it seems compared to a year or 2 years ago in China. So is it still a bargain right now, even after its short burst of recovery? So we can see that in terms of valuation, all this market that we talk about, including the China Shanghai Composite, they're trading at very reasonable price to earning ratio, about 12 to 14 times. You can see that historically range, they have gone as low as 8. A few years ago, they're at 8, 9, 10 times earning as a whole. But now they have rebounded a little bit. But it's nowhere near when people are extremely optimistic about them, say in 2010, right? So this is the situation right now. But if you compare it to maybe other markets, especially like the US market, where it's pretty rosy right now, even regardless of what is happening daily politically, the market seems to still be very, very optimistic, and they're even trading slightly higher than their 10-year average valuation. So it begs the question, when that is the norm for the main US market, could we invest in when we invest in the Chinese market, could it be a way for us to start diversifying a bit, away a little bit of the risk that we could face in the US market because it's so expensive right now and so optimistic right now? And especially at the time where the Chinese market valuation is still, I would say, pretty reasonable. Nowhere near as cheap as before, but still pretty reasonable. And one of the key things after investing for so long in both the Chinese market and the US market is I realized that it's actually much harder to pick particular stock in the Chinese market, mainly because each of the stocks, regardless of the company that you invest in, the biggest stakeholder in every single Chinese company is not the investor. It will always be the Chinese government. So if we invest in Tencent, if we invest in Alibaba, regardless of what is good for the company to do to reward shareholders, they first have to make sure that the government agrees with them. And every time the government don't agree with them, we'll see a huge disruption in their share price, and the shareholder will be one that will be affected. So it will become a very hard task for us to pick individual Chinese stocks. And this means that when we invest in the Chinese market, a big part of it, I would say, relies more on luck compared to a US market where it's more free market based, right? This means that for the Chinese market, I would actually feel using ETF to gain exposure to this market could be a better choice compared to us jumping in and trying to pick stock, because the risk of uncertainty on a sudden change is a little bit too high. So I want to highlight to you guys just a few of the interesting ETF that you could look at. And these are some of the ETF that I wouldn't say all, but some I have also invested myself, and some I have also discussed with my clients for them to think about including into their portfolio as well, right? So the first one, I would say, you can see, okay, this is how we read it. Let me just try and remove this a little bit. Okay. So the first one is the ticker. So if you go to Google Finance or anything, when you put in, this will be the one that you can find out. So for example, right, MCHI, this will be the iShare. Oops, am I able to load it up? Anyway, I can't load it up, but you'll be able to see it here. Something wrong with my browser, but oops. The ticker is MCHI, and the full name is actually iShare MSCI China ETF. And this one is actually listed in the US market, right? And what they are investing in is broad market across many of the big, large cap China companies. So you can see that top 10 holdings is Tencent, Alibaba, Xiaomi. Uh, TR is their total expense ratio. So this would be because all of them are funds after all. So there will be a annual fees that the fund manager will charge, and this will be the rate that they are charging right now. So the next one is KWEB, which is Crane Shares CSI China Internet ETF. So this will focus again in the China market, but a lot on the internet space, so the software companies. So this one has a higher expense ratio of 0.7, and you can see some of the top three holdings is quite similar. Next one also listed in the US called PGJ. This is a little smaller ETF, Invesco Golden Dragon China ETF, which is why I share with you the Golden Dragon China Index just now. So this is one that tracks that index. So they are buying all the US listed China companies within it, and the expense ratio is 0.71. Now we move on to some of the ETF that is listed in Hong Kong as well. So if you prefer to invest in the China market through the Hong Kong Stock Exchange, you prefer that to hold it in Hong Kong dollars rather than US dollars, although they are almost the same. Then you have one of the biggest selection for you is Hang Seng Tech ETF. 3067. Hong Kong, the ticker is by number. Oops, is by number. So this is 3067. For most of the Hong Kong ETF, they actually have they tend to have two options. So you can buy it in Hong Kong dollar, you can buy it in US dollar. So for example, the Hang Seng Tech is ETF. The Hong Kong dollar one is has a ticker of 3067, but the US dollar one will be 9067. So, but if you Google it, you should be able to see either the US dollar or the Hong Kong dollar once. The expense ratio of it is 0.25. And you can see that they invested in companies like Tencent, NetEase, or Alibaba. These would be companies that are already listed in the Hong Kong market as well. Or you can just buy the whole Hang Seng Index, which is the most famous one is Tracker Fund. This is 208, 2800 Hong Kong. And this is buying the whole Hang Seng Index. This includes the Hong Kong company, includes the Chinese company, includes the banks, everything. But you can see that because this is one of the key staple ETF in Hong Kong, the expense ratio is very, very low, just 0.07%. 0.07%. That's extremely low, right? Um, and last one, let me move this away. And the last one is iShare Core CSI 300 Index. So this will be investing mainly on just the CSI 300 Index, right? More of the China listed companies. So this will be the ones that is a little bit different. That you'll see companies like Guizhou Moutai, CATL, Ping An Insurance, or all the jazz. Okay. Oops. So when I talk about investing in the China market and how we can take a step back on how it can fit into our entire portfolio, this is exactly what I'm trying to share. So I take a long-winded way of explaining the entire flow on what exactly when we start defining what exactly is the Chinese market, what's happening in the Chinese market, what could happen in the Chinese market, how you can invest in the Chinese market, but also how it could fit into your own personal portfolio. And the key thing where I really spend more time with my clients is in this part of trying to understand their situation and coming up with exposure lists, right? On allocation lists on exactly for their portfolio, how they can position and invest in different asset to gain exposure to different market so that it gives them the peace of mind and to give them the diversification that they need, right? And you can see that this is just an illustration, right? Even if we are very optimistic about the Chinese market, it doesn't make sense for us to say that, oh, then buy 100% into the Chinese market. Unfortunately, that has been the case, I think, for over the past few years where China was in the optimistic stage, and we see unfortunately that many funds are being pushed out to push investing in China, and I have some clients that now when they come to me and do like a review on their portfolio, I realize that they are holding too much exposure to China, and many of them because they are losing money and they refuse to sell and realize that loss. So end up their exposure to the Chinese market is pretty high. So which is why I said, you know, regardless of how optimistic you might feel about a certain market, at the end of the day, it comes back down to sizing. And sizing is important not just to maximize our potential return, but also minimize our risks. So even if we are extremely optimistic about China, I don't think having 100% allocation to China is a wise decision. Because at the end of the day, investing is a game that I see it. I see investing as just a game. And it's a game of probability. And in a game of probability, we can never be sure. There could be a high chance, but we can never be sure, which is why we diversify. If I'm 100% certain on something, there's no need to diversify. I just buy one stock for the rest of my life, right? Some people does that. Sometimes they get lucky. Most people get unlucky and never trust stocks ever again in their life. But I would say to do it more consistently, this is something that I plan for my clients. And even if you want to do it yourself, I would say that, spend some time to think about how allocation fit into your portfolio. And then from there, only once I have a say an agreement with my clients, then we could look into things like what could fit into that portfolio to give this particular outcome that they want. And from there, then this is again just a illustration purposes. From there, then we start selecting a possible ETF or funds to meet that goal. I try to eat my own medicine, meaning that I'm a big advocate for ETF and how I feel that these are superior instrument for us to build our long-term wealth. And I also use it to craft a sample portfolio, especially for to show with my clients. Sometimes I update them as well how it's doing. But since I joined iFast about a year ago, the first thing I did is starting this sample portfolio, and I started buying ETF under my own personal account, and this is how it looks like at the moment. Okay, I think these are something that we can talk about in the future. But so I hope you enjoyed this particular webinar, and if you want to speak with me, I share a little bit about my process over this webinar, why my philosophy. Some of the things that I also do is not just on the investment side, but also thinking about how to systematically do a financial planning for my clients as well, right? I have spent the past year getting my certification as a CFP, a certified financial planner professional, and I have found a few software that I use now to go through with my clients to plan out, some of the things that they have plans for in the future. A big part of them, of course, for retirement or for kids' education. These are some of the big finances expenses that we have to plan for. And using software, it allows me to show visualize it for them. And I have clients that is very worried that they don't have enough for retirement, but when I put in their current situation into the software and simulate out different things for them, they're able to see that actually, hey, they're not in that bad of a shape, uh, and give them more peace of mind. I have also other clients that assume that they are pretty good, but when we put into the system, it highlights that they might be in a more dire situation than they expect. So I think what this part give is a good clarity on our own situation, and I always believe that to invest is to plan for the future. But to plan for the future, we first must know where is our starting point. And only when we can be clear and being honest with ourselves on where we're starting and where we're going, then it will have a much higher chance for us to reach our goals, right? So everything that I talk about, these are things that I talk in much more detail with my clients as well. So if you're really interested, to kickstart this discussion with me to think about to start taking your future financial plan more seriously and want to take charge and start to think about how to build your portfolio for whatever particular dream that you might have, feel free to reach out. And I hope to hear from you soon. Just scan the QR. You will link to a Google Sheet where you will let me know that you want to speak with me, and I'll reach out to you. Or you can reach out to my website learnwithstanley.com. All my main social media or email is listed on the site. Um, I do that because there are some instances where I have uh, I have members or people approaching me saying that they are scammers who are impersonating me. So please only use the contact that I have listed on learnwithstanley.com. Those are my account. Other than that, I would never ever have other accounts on social media, and I will never solicitate to anyone randomly, right? So unless you reach out to me first, I will not randomly reach out to you to share some amazing investment scheme. So please beware of all those, right? This is my website, and when you scroll down to click on free financial health check, you would also find that Google Sheet, and you can reach out to me. Or if you're in JB, drop down to our office. Our office is in Taman Molek, and just let me know. And I hope to see you in person as well. Okay. Or you just want to follow me a little bit more on social media. I'm most active on YouTube, Facebook, or LinkedIn. So this would be the three. And you can find all those link on my website, learnwithstanley.com. Before we end, last two slides. This is our spin-off segment. And I always wanted to share a little bit things outside of investment, but I find fascinating. And this week, maybe a little bit different. I tend to share some podcasts that I'm listening to, which is inspiring to me, or some books that I'm reading. But this week, because I was traveling and I spent a lot of time at night just with my 5-year-old, where she asked me to replay this movie, K-pop Demon Hunters, over and over and over and over and over again, right? And I have to say, I was enjoying myself as well. And I think that this movie, in particular on Netflix, is a real masterclass on how to create content in the current landscape, right, for the new generation. And it has been able to reach a viral point that I think that even company like Pixar or Disney has never seen before or could only dream of. And they are able to create content within the movie that you can turn it into like a TikTok 15 seconds, into a YouTube review, into so many different platforms. I think they have planned it out spectacularly well to make a viral content on a private platform like Netflix, where people has to pay to view the content. It's not even available on public domain. So I think that's a real masterclass on creating content, and I think just for interest, I think you should check it out as well. If you have kids, I am pretty sure you have already seen it. Right? All right. And thank you so much. Before I jump into Q&A, just to have a quote that I always live with. Every single webinar I live with a different quote, but this is one that I come across this week, which is from Paulo Coelho, and within his most famous novel, The Alchemist. And it says, there is only one thing that makes a dream impossible to achieve: the fear of failure. And I think that regardless of how whatever dream that you might have, right? It doesn't have to become a billionaire or have grandiose dream. In my 20s, I used to have grandiose dream, but I think as I age more and more, I realize that simple things are much harder to come by, and most of my dreams are very simple right now. But I would still have to work towards them. And the only thing that is stopping us from reaching and and reaching our dream and fulfilling our dream is not even starting. And one thing that most people fail to start is because of the fear of failure. And I think once we realize that and once we drop it off, that there's nothing really to be afraid of, we could start to see more beautiful things happen in our life. Thank you so much. I hope you really find today's webinar useful to you. And if you have any question, feel free to let me know. Uh, Let me see if you have any question. Wei Han, in your opinion, A50 or the CS1 300 is better for long term? Is there any example in Sing dollar? First question, A50 or CSI 300. I would say that I would prefer ETF that is linked to CSI 300, mainly because there's more companies and it's just more diversified. Um, yeah, and it involves some of the software companies and tech companies as well. Whereas A50 typically are only companies that are listed in the A shares, less tech dependent. I myself tend to focus more a little bit on the tech sector, so that's one. One that is in Sing dollar. I can't really think of one at the top of my head, but I would say that even if there is, um, you can't really remove the currency risk completely. Mainly because at the end of the day, the underlying you are investing in the China market, be it A50 or CSI 300, and their business is in renminbi, their shares is in renminbi. So even if the stock and the ETF is traded in Sing dollar, the currency risk is still there. You just don't see it, right? Does that make sense? So hope that answer your question. For Ken and Yo, I think you have a complaint that my image is a bit too big, blocking the word of the slide. Uh, Let me go back to whatever slide that you might be looking at, and let me cancel my face for you so you can check it out again. Okay, maybe some of the things that we talk about. Let me see if which one I'm blocking. Okay, I understand already. A lot of the table. Okay, sorry. Okay, so this one, the index and their valuation. You can see that China market is not cheap, but still reasonable. This one, yep, the ticker for Hang Seng. You can maybe take a screenshot if you want right here, and that's about it. Okay, no problem. Again, thank you so much for all your time. I hope you enjoyed, and I really appreciate your time with me today. And I hope you get value from the webinars that I've been putting out. If you have any feedback for me, feel free to reach out. If you want to speak with me one on one, learnwithstanley.com, you can reach out to me. Anyway, till we meet again, my name is Stanley. Invest safely, guys.